Good morning, traders and investors around the world. Welcome back to Pre-Market Prep with Stock Odds. Joel Elconin here with Rob Friesen. Back on the saddle because we wanted to help you out today because the market is running into some trouble. Let me share my screen. Let me run down the S&P 500. Let me run down the rest of the futures, and then we'll get to Rob, and we'll talk about seasonality. Let me share my screen here. What was 30 handles of gains has turned into 36 handles of losses. New low for the move, down 36 at 95, 35, 35, 39, 95 and a quarter. We're kind of free falling here. Let's see if we can catch a bid somewhere. Coming up on 50% retracement of that move off the June low. Crude give it back when it made yesterday, down 410 at 92.90. Gold getting shellacked. That's down 14.30 at 17.35.40. Silver in the red, 35 cents, 18.32 and a half. Bitcoin under 20K, down $100, 19,865. And Ethereum still green on the session. 650 up 15, 2150. We just hit a rough patch in the market here. Seem to be free falling now. I believe that was who's used to sing that song, Rob? Free falling now. You got some news? Is it news or just a good old fashioned sell off?
I don't know. Let's check.
Welcome back, Rob. How you doing?
Not too bad. Not too bad. Let's just check, eh?
Let's see. I'll check my sources too. I mean, price dictates all, but yep, we just gave back half of that move. Just took out our July 28th low at 94.50. But hey, let's talk seasonality, Rob. And if you're talking about seasonality to buy the dip, I guess you're getting some little bit of discount here.
Well, it depends what the seasonality is. So, I mean, people underestimate the power of that context that you can have. One of my traders recently did really well using the July and into August seasonality, and had a little chat with him and said, hey, make sure you look forward to the calendar because we're about to get a change in the bullish nature of the market. And this was I had the conversation on August the 15th. So we're about to get a change in the nature of the market, and you can look at the seasonality calendar again. Don't just lean on something that we say like, okay, this is a good month. If you're coming to the end of a month, look at the next month. So he did, and he really cut back, and he thanked me yesterday. Said saved him a lot of money. Tucking in some positions and not being exposed to this recent sell-off, which we talked on the show that, after expiration, you can often get a change anyway, right? So we had our August expiration and we saw a change. So, let's look at my screen here. Did you run through everything already?
I did. I ran down. Let
me have the screen here then. And, yeah, I'll just put it up here, screen 2. So again, we can go to seasonality here and look at things based on August. We're coming to the last trading day of the month. Always a very interesting day. Remember that if any institutions are active in the month of August, there's a lot less that are, but if they are and they have leveraged up, because we came into August with a pretty good risk appetite, and if they loaded up on stuff, might be the day to deleverage tomorrow. So we can go to the last trading day of August. Let's see that it's down. Now, notice this little bump here, the five trading days. So on Thursday last week, we had already exceeded in that first day the whole 5-day window. So that's something that's really important to watch for whenever you have events that are seasonal, are, you know, understood by a lot of professional, you know, participants and so on. And it gets ahead of itself, you know, and uses all of that built-in expectation and energy up. It can reverse on you, and that's what we saw on Friday. Is that you know, it's the cause wasn't just the fact that we overdid seasonality, but look at it from that perspective of that if you were expecting the next 5 days to kind of, well, even not the last day, of the 5, just maybe, you know, 1 to 4 days would be good, but we used it all up plus, and we start to have a catalyst of heading the other way. You know, you're not gonna get the remainder of the seasonality because you already used it up. So that's what we had coming into Friday last week, and so Thursday was the first day, Friday was the second day, and today we're in the 4th day of seasonality, and tomorrow is the 5th day, the last trading day of the month, and it's expected to be down historically. And most last days of the month are actually down. So then we roll into September, and we want to know what's going to happen on the first trading day of September. Down. First Friday is also this week, and not looking so good. A little bit better for the Russell than it is for the SPY. But look at the whole first 3 weeks here of this month up into expiration is, you know, not a bullish window. So we had, you know, compare that, let's just go back for a minute and compare that to July. We came out of that super discount, you know, May and June. We moved past the expiration in June, past the Russell rebalancing, and we had great seasonality expected for July, 2.7%, which we exceeded in the rally that we had. And rolling into August, still slightly bullish. And again, most of it was factored in for the last part of August, which we saw that bump, and then of course we faded. And then moving into September. So it really helps give you that context. And the question always is this: what are the macro catalysts that might be interfering with it? So if we look at, you know, how is the US dollar performing, right? Well, here's the dollar. It's really, really, really strong still. And it's putting a damper on all these other currencies. Look at all the other currencies. You know, the euro. Now the euro, you know, with pending rate hikes to battle inflation, you're possibly going to see a little bit of a rally on the euro and a little bit of a pullback on the dollar, because that's generally how they work. But look at all the other currencies of the world. So, you know, Canada's commodity rich. Its dollars under pressure. Australia, same thing. New Zealand. So the US dollar is that flight to quality. It's you know, it's exporting inflation to the rest of the world even more aggressively than you feel it in the US. But it's big related to the commodities, because if this thing was to pull back huge, then you might see the commodities really lift, including oil. I know we're having a profit-taking session on oil today, but there's still a lot of legs in oil, especially if the dollar pulls back. So keep an eye on the dollar as a major catalyst, of course. So yeah, back to our seasonality. So as we look out into September, we see it's very rocky these first 3 weeks, and maybe our rally comes near the end of September. Now, everybody thinks that October is a big sell-off month, but it's actually just a volatile month. It can be both ways. But with the midterms coming up, you know, there's that. There's a lot of stuff breaking out in the Middle East. You've seen the Baghdad's gone bananas again. You've seen what's going on between Israel and Iran. You've still got Russia and Ukraine. So there's a lot of still backdrop of trouble in the world. You may not feel it in your jurisdiction where you live, or you may not even see much media coverage. But if you do get to some of the networks that are more specific to those regions, you'll see a lot of stuff. And then you've got water problems on both sides. No water, or like in Pakistan, too much water, which has wiped out, I think, 90% of the agriculture. I mean, there's a lot of trouble brewing this fall. So don't think that we're all positioned for rally monkey mode again. I don't think that's the backdrop. And we're contending with the quantitative tightening. We've got the most aggressive quantitative tightening here these next few weeks. They're shrinking that balance sheet. Interest rates are rising, so you've got rising rates along with QT, and some are expecting that target of 3.8%, as Powell said, may stay up there longer. Some are expecting it to even exceed that. So there's not a lot of great arguments for the bull side. Now, what we can always do is dig through StockOdds, and here's StockOdds today for this is just the S&P top 10. So it's the stocks themselves are falling, but you do have your hedges that you can use, and this is the most important thing that we can try to teach you, Joel and I, and at StockOdds Learning Academy and so on, is the value of trading relationships, the value of trading pairs, the value of being hedged. We're down open to close on the stocks 1.14% right now, but the hedges, just using your ETF hedges, we've gained 1.57% on our shorts. So the list is profitable. Now, if you chose to use SDS, if you have the stocks plus SDS, you're up 0.27%. So still green on the list. That's only using $1,000 per symbol, $10,000. You're up 0.27. So yeah, while you can have directional exposure, we're not really in the season that you want directional exposure. You want relationships. You want, especially if you're swing trading, because what a difference a day makes, right? And anything can go crazy again. I've been saying for years, you might see a dirty bomb go off in some city in the world, right? Like all kinds of stuff could happen. And so hedging is so essential to your career, to protecting your capital, which is your major work tool, right? Your capital is your hammer that you come to the job site with. And we just really recommend that you learn to hedge. So the choices with just a simple list, if you go in and you select some things, this is quite diversified. There is an energy stock in here, Baker Hughes, Conagra, Colgate, Disney, there's utility Edison, consumer discretionary Expedia, there's another energy Hess as well, and then energy's having a bad day, so that's pulling us down a bit, but CarMax and VFC. So there's some it's not, I wouldn't call this list highly defensive. I would say there is a couple defensive stocks in here, but it's not highly defensive. But they all had reasonable odds for performing for the day, right? So here's your odds, here's your expected performance. But what's happening in the market? The market's pulling everything down. Well, almost everything. I mean, there might be a few green stocks here and there, a few green shoots, there always is. But is that what you want to focus on? Just your singles, trying to find the green shoot and fight the trend? Or do you want to go in there with pairing stuff up. Even a stock versus an ETF can be amazing for you, as you can see here. And it's still falling. We're down 1.2% now.
Yeah, this is
right?
quite. I mean, there's no let up here.
Right. So one of the things I want to teach is how to recognize the signs everywhere. Sign. There's another song for you, Joel. And you can increase the weight, the capital weight on the short side, right? As you're seeing the signs play out, as you're watching your indicators, you're watching the levels break, and so yeah, it's keeping pace. The ETFs are now up 1.5%. Well, they're down 1. So we're short, so they're up. So our profits are actually growing. Now, if we got a bottom on the day, it happened yesterday. Like we hit, we didn't have a big range yesterday, but we had most of the move was pre-market. Yep, but we had a little example there where things kind of showed that they didn't really want to go down. There was a risk appetite, and we started to chop upwards, and we eventually filled the gap at around halfway through the day on the SPY. And so we went to the previous close. So it's like, if you see the signs, you could pull off. Like if we actually got a bottom in and we started to turn up, we could start lightening up on our hedges. And then if these stocks come back, you've locked in the profit on the hedges and you get your money back on your stocks. So remember, it's a market of one largely, right? You don't have the luxury of like ignoring what the market's doing. You just don't have that luxury as a trader. And timing is everything. Like, for example, this trader that thanked me for, telling him about September upcoming seasonality and the change that we're about to have in the markets, said it saved him a lot of money. A dollar saved is a dollar earned in this business. So you do want to save money, right? You work hard for it. So just, you gotta learn to hedge. I mean, this is a simple hedge, SDS, either beta adjusted, which that really helps. Our beta is 1.06, so a little bit extra capital on the SDS is definitely pulling in a little bit more money here. So, but nonetheless, just using straight up capital, and you get to use half the capital on SDS because it's a 2x inverse. So if you buy it, you're using half the capital that you would if you were shorting the sector ETFs.
Got a quick question for you here, Rob.
Yeah.
And this is a tough one, because there seems to be, this is from Eric M. There seems to be an inverse relationship between energy and the rest of the market. Could you use the XLE as a leading indicator while this relationship exists? I'm gonna tackle this one first. And I mean, the reason that the market was up today was because oil was down. And that surely isn't working now. I can't really seem to put I mean, like, for me with the oil and the, with the manipulation, I mean, it's just, to me, it's just hard to rely on oil for anything. I'd like to hear your take on that, Rob, and then we'll wrap things up.
Yeah, I mean, there are times where I'm like, again, this list is not vetted, but I'm hoping some days that it doesn't have a lot of oil exposure. And some days it's been good that it has, but really it's about OPEC and about the relationship between Iran and Russia regarding oil, and again related to what's happening with the Iran nuclear deal. Those are some of the major catalysts that are affecting what happens day to day. No different than, do you remember going back to sort of June and July initially, more and more so in June, but this sort of inflation, peak inflation versus there's years to come. Remember how fickle it was day to day with people's opinions. Some influential person would talk one way and the markets would respond, and then another person would talk a different way and it would respond. And so we're kind of in that with oil. Otherwise, listen, the backdrop in terms of demand is still kind of there, other than we just had another lockdown in China in the electronics area, just for a few COVID cases to lock the whole thing down again. So that's the lockdowns are demand destruction, right? But the economy, firing on all cylinders, is demand increase. Recession is demand destruction. No recession, is business as usual, and the demand is there. Then you go to the supply side, you go to the OPEC and what could happen there, whether they're going to cut. So these are the things that are affecting oil on a day-to-day basis, and it's actually, Joel, it's actually no different than what was affecting the SPY, the Qs, and the Dow and the Russell for the inflation, duration and intensity, and the recession potential and intensity, right? So those same factors, but oil has different, but I'm just saying it's the same kind of movie, and it says one day up, one day down, one day up, one day down. Now, I think oil is very possibly, if OPEC cuts and things keep going the way they're going, I think oil is going to take another shot at the highs that it had before. That's just my personal feelings, but
yeah, it's just. But if we're having this true economic slowdown and everything, then people aren't going to need oil. They're not going to be able to afford it. They're not going to be able to afford to leave their house. So,
well, I mean,
don't understand
unfortunately, no, but unfortunately, that's not. I mean, you still got ships that you still got airplanes, and then the thing is, look at the prospects for travel. Everybody. Travel industry is expected to continue to boom because, people, this is what they want to do. I mean, I just had a friend that just got back from a cruise and now booked three more cruises, right? It's just like, people are just crazy for travel, and you still got goods that have to move around the world. And the real problem is, what is the supply? And, potentially for the US, we've now dipped 80% into our strategic oil reserves. I mean, are they not there for when there's a real problem? So I just think that it wouldn't surprise me, put it that way. It wouldn't surprise me if we go back to the highs and even exceed the highs on oil, but it's going to be not a smooth sailing. It's a rocky road to get there. It could happen fast if there was significant cuts. So, for example, Iran isn't bringing more oil. Something doesn't go with these nuclear talks, and it's not coming out to the market, other than to Russia or back and forth, whatever. Or Russia sells its oil through Iran. I don't know, but yeah, the OPEC thing is a big one, right? Are they going to?
Yeah, I mean, they say that they're going to do supply cuts, and then the actual numbers come up, and they're not doing supply cuts. So
and that's what's moving it around, right? So,
yep, exactly.
So it is tricky, but guys, if you don't like a certain sector like that, like for example, if you don't like technology, you don't have to play it. If you don't like oil, you don't have to be in that. So if you want to be in that, if you see some great volatility opportunity, then be relationship-based trading. Some of my pair traders that are in these oil pairs are doing great. Like the volatility is fabulous. The earning an ATR or two a week from the pair. So that's kind of one of the metrics is whatever that volatility is of the pair. We're in the kind of market where you can make usually you would target one ATR a week from a pair. We're in the type of market with oils that you can make 2 ATRs a week. So if the ATR on the pair is like $1, you can make $2 a week from that, with just the elasticity of those relationships. So find your good pairs and work them, trade around your core position, there's enough volatility to really not even have to swing trade them if you don't want to take them overnight. You can do.
Hey, Rob, I gotta wrap things up here today. But
anyway,
we just hit 68.50. We're trying to bounce. what I'm focusing on today for the rest of the day, 39.83 and a quarter. That's midway to your rally. So let's keep an eye on that for the remainder of the day. Thanks for joining us on Pre-Market Prep with Stock Odds.